I think we are in correction mode right now. We could be down 10%.
There's going to be a bigger dip.
The Fed has come to realize the economy is strong, inflation's a little sticky, so there's really no rush to lower interest rates much more next year. And now they're talking about 2 rather than 4.
The market just had a major freakout, and you want to know, is this just a minor hiccup, the beginning of a bigger correction, or the end of the bull market? To figure this out, we first need to understand what triggered the sell-off.
Yes, the Federal Reserve did indeed reduce the number of rate cuts it projects.
The slower pace of cuts for next year really reflects both the higher inflation readings we've had this year and the expectation inflation will be higher.
The Fed simply caught the market off guard, and this is what we call a negative surprise. Let me explain. See, the market is always adjusting to the expectations of growth, inflation, and Fed policy. But on Wednesday, the Fed surprised everyone by shifting to a less supportive stance on policy. Back in September, the Fed signaled to the market they should expect 3 to 4 rate cuts in 2025, which would bring interest rates down to around 3.5%. However, in this meeting, they rolled back those expectations. Instead of 3 to 4 cuts, expect only 2. This was the major surprise that caught the market off guard. Remember, in a bull market, assets are heavily leveraged, and that leverage comes at a cost. And when the cost of leverage rises unexpectedly, like fewer rate cuts, the market must adjust. Investors scramble to reduce their leverage, leading to a sharp sell-off. And we have another factor that amplified or exaggerated this panic: triple witching. Triple witching is one of the few days out of the year when options for individual stocks, indexes, and futures all expire simultaneously. And this creates a heightened volatility. So the Fed surprised forced many leveraged positions to deleverage just before Friday's expiration. And this resulted in margin calls, liquidations reflected by the vicious sell-off. We also saw a spike in the VIX, the fear index, as investors rushed to buy protection. And it's a reminder that markets tend to make their biggest moves from surprises, whether positive or negative. And in this case, with markets already at all-time highs, pricing in a very optimistic future, the Fed's disappointment was enough to trigger a sharp downturn. However, there were a few warning signs going into the Fed meeting. Number one, active fund managers were fully positioned, and when we see this, we often get a correction. It's like a gas tank that's already full. There's little room left to fuel us higher. This makes the market more vulnerable to negative news, and the Fed's surprise was the tipping point. Number two, market breadth was fading for weeks. Market breadth is about how many stocks are participating in the rally, indicating the overall health of the uptrend. And we can measure this in a couple of ways. First, advanced decline, how many stocks are advancing versus declining, and how many stocks are moving above the 50-day moving average. And what we see is as the S&P was consolidating higher, both of these breadth indicators were fading. Less and less participation is not a good sign, especially going into a market event that results with a negative surprise. So we know what caused the correction: weak market breadth, option expirations, negative surprise from the Fed, and that led to profit taking and a massive buying of protection expressed through the VIX index. The economy is still firm, inflation is not rising, and the Fed is still cutting, just not as much. There's no signs here that the bull market has ended, but maybe the VIX is signaling a bigger correction ahead.
Yeah, the VIX is during a mid-cycle rally like we've had since the beginning of October 2022, a very important signal about where you can step in and buy a dip. And we got a very key buy signal on Wednesday with the VIX closing at 27.6. That's just over one standard deviation. Only happened 2 times since October 22, right at the beginning of this rally, and then again in August 5, 6, and 7 of this year. And in both times, the S&P was up 4 to 5%. In the month after the VIX hit those levels.
You're essentially telling me that whenever the VIX has a massive spike, that it's generally a buy.
It is. The only exception, and think back to 2022, we had several VIX spikes to 36, which is 2 standard deviations above the mean. Those weren't great buy signals because we were still in a bear market. The point is that when we're in a bull market, these VIX spikes are a real signal from the market saying fear is overblown and it's a good time to buy. And that's what we're seeing here. We've gotten that buy signal again, and we're very bullish here.
Okay, so buy the dip.
So when the VIX spikes in a bull market to this degree, it is usually a buying signal, a signal that fear is overblown. And we saw the same thing back in August, which pretty much marked the bottom. So on a technical basis, a VIX spike is a good sign, but do we have macro to back it up? We do. We actually got a positive inflation surprise followed by one of the Fed members giving the market hope for more cuts.
It's nice to get a number that's better than expected, and we're still on path to get to 2%. If conditions keep on the way that they have over the last 18 months, I think rates come down a fair bit more.
Friday morning, the Fed's preferred inflation gauge, the PCE index, came in lower than expected. PCE is the inflation metric that guides Fed policy, so it's only natural that a lower than expected print is positive for the market. Now, although inflation is still bumping higher on a yearly basis, the month-over-month trend was nearly flat. And this suggests that bump up may be ready to bump down over the coming months. And the S&P responded, filling the election gap with explosive daily volume, the highest since the yen carry trade crisis. We also had the fear and greed index moving to extreme fear, suggesting most of this negative news has already been priced in, and the appetite for risk is starting to reset as the market digests the incoming data. And the Fed is now expecting GDP and employment to be stronger than previously anticipated, which is also encouraging for markets.
Higher interest rates don't necessarily mean a bad situation when they're caused by rises in productivity or rises in real GDP, and that's certainly one of the causes of the rise in the long-term rates.
So there's a lot of rate uncertainty, you're right, but at the same time, we've got a good economy, a good labor market, and growing corporate earnings, and that's the recipe to keep this rally going, and that's why we're bullish.
So while this sell-off was intense, it doesn't necessarily mean the bull market is over. The Fed surprise combined with structural events like triple witching and weak market breadth created a perfect storm. But there were also positives, including signs that PCE inflation is cooling and the economy remains strong. The only red flag are rising market rates, rising U.S. Treasury yields, which put pressure on the housing market who's already struggling, and we see that reflected by home builder stocks getting absolutely obliterated. The other risk is the dollar strength, the dollar wrecking ball sucking capital out of global economies and the US markets. The stronger the dollar, the weaker foreign currencies who are already struggling with stabilizing their economies.